Welcome to Breaking News to Trading Moves.
Today, we're looking at a pretty major corporate governance situation.
Yeah, it involves a very high-profile tech company and how the market's reacting to some specific institutional advice.
Exactly. We're tracking the fallout from a recommendation by a key proxy advisor.
And this concerns what people are calling the largest corporate pay package ever proposed. The numbers are just staggering.
They really are. Uncharted territory, like you said.
So our goal here is to lay this out for you. What the governance concerns actually are, why this one recommendation can, trigger money moving around.
And where that money seems to be going, which sectors, which specific stocks, using their tickers.
Okay, so let's start at the core event. Institutional Shareholder Services, ISS. They've recommended that Tesla shareholders vote against Elon Musk's new compensation plan.
Yeah, a very direct challenge, not just a minor quibble.
And this comes just before that big shareholder meeting on November 6th. The package itself, the material we have describes it as potentially worth around, $1 trillion?
Approaching that, yes, tied to some incredibly ambitious milestones, both operationally and for the company's market cap.
$1 trillion. I mean, that number alone seems to be the heart of the governance concern.
It's central to it. IS flagged two main things. The potential dilution for current shareholders.
Meaning their stake gets smaller.
Right. And second, whether the structure itself properly balances the massive potential reward against the risk, especially given just how huge that payout could be if the targets are hit.
So why does one recommendation from ISS carry so much weight? Why does it immediately cause ripples in TSLA and other stocks?
Well, ISS is a really important signal for the big institutions. Think pension funds, index funds.
The major asset managers.
Exactly. Many of them actually have internal policies that lean heavily on ISS recommendations, especially for contested votes like this one.
So an against recommendation isn't just advice. It can almost trigger a no vote from some big players.
It significantly raises the odds of a contentious vote on November 6th, and that introduces what the market labels governance risk.
Okay, governance risk. That sounds a bit abstract. What does it actually mean for investors looking at TSLA?
It's quite tangible, actually. It means the market immediately starts pricing in more near-term volatility for the stock, TSLA.
More price swings.
Right. And maybe more importantly, it forces investors to step back and reassess other risks. Things like execution risk, that dilution potential we mentioned.
And maybe concerns that leadership focus gets tied up in this governance fight instead of, building cars.
That's part of it too. Leadership focus becomes a question mark.
Okay, so if there's sudden uncertainty around a giant like Tesla, that tends to push capital elsewhere. Money looks for stability, maybe.
Or just diversification away from that specific risk. And yes, we're seeing capital rotate.
So where is it moving into? Who are the winners from this potential Tesla distraction?
We're seeing movement into a couple of related areas, primarily within the auto space itself.
Okay, first up, legacy U.S. automakers. So GM&F, General Motors, and Ford.
Correct. GM&F. The thinking here is sort of trading that high governance volatility at Tesla for more stability.
Right. Established companies, dividends.
Exactly. Investors might rotate out of the TSLA governance story and into these Detroit names that pay dividends, have established businesses.
But they also have their own EV plans, right? It's not just the old combustion engine business.
That's key. They offer growing EV lineups, so they have that future angle covered. But they also have these diversified, reliable cash flows from the traditional side.
That diversification acts like a buffer against the kind of single stock risk we're seeing with TSLA now. Makes sense. Okay. Besides Detroit, there's also a positive reaction for some of the U.S. EV challengers.
Yeah, this is more of an intra-EV rotation. Think peers like RIVN, Rivian, and LCID, Lucid.
So investors still want EV exposure, but maybe less concentration in Tesla.
That seems to be the play. If institutions want to maintain exposure to the EV sector, but trim their TSLA position because of the governance overhang, these other names can benefit.
And investors might be looking at upcoming catalysts for RIVN and LCID, like new models or partnerships.
Exactly. Positioning based on their specific upcoming news flow.
Okay, now the third winner is maybe less obvious. The actual proxy and shareholder communications infrastructure.
Yeah, it sounds a bit niche, but it's a predictable reaction. When you have a really high-profile, complex, and likely contested shareholder vote like this one.
Especially with a package this size.
Precisely. It massively increases the workload for companies that handle proxy distribution, vote tabulation, shareholder communication, all that governance workflow stuff.
So managing this whole process is complex and drives business for certain companies.
Absolutely. It's complex work, especially coordinating millions of retail investors alongside thousands of institutions. This creates demand for the platforms that manage it all.
Which specific names benefit here?
The material points to BR, that's Broadridge Financial, and NDAQ, NASDAQ. They provide these critical services. A huge contested vote means more business for them. Guaranteed work, really.
Okay, so we've covered where money might be flowing to. Now let's look at the flip side. Who's facing headwinds? Where is sentiment turning cautious?
Well, the most obvious one is TSLA itself.
Right.
TSLA, facing that immediate governance overhang.
Right. The uncertainty leading up to November 6th, the dilution risk.
It all puts pressure on the stock's valuation multiple, increases that volatility we talked about, and sometimes this kind of pressure can spill over a bit to other, mega cap growth stocks that might have their own governance sensitivities.
Okay, so TSLA is the direct hit. But the concern travels down the supply chain too, right? Particularly battery materials.
Yes, specifically looking at U.S. lithium producers. Names like ALB, Albemarle, and LTHM. That's Livent Corporation. Although they merged, the sentiment impact applies.
Why them specifically?
Because any hint that Tesla's growth might slow down or that they might pull back on capital spending due to this uncertainty immediately hits expectations for EV battery demand.
And lithium is crucial for EV batteries.
Exactly. So these stocks, ALB, LTHM-related entities, they act as a very sensitive barometer for overall EV production expectations, heavily influenced by Tesla.
Okay, beyond raw materials, we also see potential impact on specific EV component suppliers. Something about power semiconductors.
That's right. Specifically, companies involved in silicon carbide or SuSiC technology.
Why silicon carbide?
It's really important for EV efficiency, used in things like inverters and drivetrains to boost power efficiency and range.
Got it. So if investors worry that Tesla might build fewer cars in the near term because of this distraction,
then the suppliers of those critical subpending components might see their own valuation multiples compress. Even a slight softening in expectations for Tesla builds can ripple through.
and the names mentioned here.
Look at ON, that's ON Semiconductor, and WOLF Wolfspeed. They are key players in that sticky space for automotive.
Okay, so for you listening, trying to navigate this, what are the absolute key details and dates to keep front of mind?
The big one is the date, November 6th. That's the shareholder meeting. All this uncertainty, driven by the ISS recommendation, will likely persist right up until then.
And the core driver of all this reaction is just the sheer scale of the proposed package. That trillion-dollar figure.
That's the mechanism. That unprecedented number is what's fueling these cross-sector governance concerns and the resulting market moves.
Now, the material also mentions some specific ways traders might try to navigate this volatility, using particular structures or trades.
Yeah, with heightened volatility, you often see more use of defined risk option structures, things that cap potential losses but still allow participation, specifically designed to cover the period through the vote date.
And beyond options, there was talk of pair trades.
Correct. Pair trades are common in situations like this. They focus on relative performance between two stocks or groups of stocks.
Can you walk us through an example, like the TSLA versus Detroit one?
Sure. A classic rotational pair trade here would be going long GMRF, betting on stability, while simultaneously going short TSLA, betting against the governance uncertainty.
So you're trying to capture the spread if capital rotates from TSLA to GM or F, regardless of what the overall market does.
Exactly. It's a bet on that relative shift.
And the other pair trade mentioned involved the infrastructure winners versus the potentially weaker suppliers.
Right. Another idea is pairing a long position in, say, BR, Broadridge, betting on the increased proxy activity.
Against a short position in one of those high beta EV suppliers we discussed, like ON or WOLF, who might be pressured by softening EV build expectations.
It's a way to play the governance complexity benefiting the service providers while potentially hurting parts of the manufacturing supply chain.
And even if you're not actively pair trading, keeping an eye on those lithium and semiconductor names is important. ALB, LTHM related names, ON, WOLF.
Absolutely. Watch them for sympathy moves. Their price action can give you clues about broader market sentiment towards EV growth, and how the Tesla situation is being interpreted as commentary evolves and, of course, after the vote outcome.
It's really a clear example, isn't it, how a single huge governance issue, this unprecedented pay package, can immediately cause capital to flow differently across related sectors, from legacy auto to niche suppliers, even to the financial infrastructure companies.
It really highlights the interconnectedness. And maybe a final thought for you to consider. How might the actual outcome of this vote on November 6th, whether the package ultimately passes or fails, how might that set a new precedent?
A new expectation, maybe, for how major institutions engage with executive compensation, especially at other large founder-led tech companies down the road.
Could be. It's definitely something to watch.
Okay, that wraps up our look at the market reaction to the Tesla Compensation Plan advisory. Just a reminder, this is not financial advice, nor are these buy or sell recommendations. This is purely the opinion of the author.